CEO of Abra. Welcome to another exciting episode of Money Talks. Today's we're going to do things a little different. Probably going to have a little bit of a shorter episode today because I really want to focus in on two things. One, I want to give you an update on my personal investment thesis around Bitcoin and cryptocurrencies. And two, we'll talk a little bit about stablecoins and answer some of your burning questions on both topics. All right. So we're going to share this video far and wide. Afterwards, I'd really like you to share this video with your friends, family, anyone that you think really needs to understand what's coming, right? There are some pretty special, crazy times ahead. I want to give you my take on what it's probably or possibly going to look like. Okay. So, as you know, several weeks ago, I came to the conclusion that the Bitcoin rocket is about to take off. So now, as a result, I increased my personal allocation to Bitcoin to 50% of my investment portfolio from 15%. To be clear, I'm not giving investment advice that all of you do this. I simply want you to be aware of how bullish I've become. So why did I choose 50% for my portfolio for Bitcoin? There are several reasons, but the bottom line is that I believe that Bitcoin is the single best investment opportunity in the world right now. My analysis comes down to three things. First, I want to talk about fundamentals. My long-term thesis on why Bitcoin is so special has not changed in 10 years and has only been strengthened over time. There will never be more than 21 million Bitcoin. We talked about why Bitcoin is so important last week, and the fundamentals are as strong as ever. Bitcoin is the hardest asset that the world has ever seen. As the minting of new Bitcoin approaches zero in the coming years, its value versus fiat will continue to skyrocket, in my opinion. Again, it's my opinion. We can also look at it another way. Cash or government printed money, also called fiat, is actually becoming worthless while Bitcoin's value remains constant. There will never be less fiat printed than there is now. Cash is only going to get more and more worthless. What are the chances that governments eventually decrease the global money supply by taking cash out of circulation? I'd say zero. As I said, cash is simply becoming more worthless every day. Hard assets are going to rule. An asset that is guaranteed scarce over time is the hardest asset of all. As a reminder, Bitcoin's stock to flow ratio tells us that the amount of Bitcoin in circulation will top out at 21 million and never go beyond that. And at that point, Bitcoin stock to flow is infinite, meaning that it would take an infinite number of years to recreate the supply. Even gold's supply can be recreated in a few decades. That makes Bitcoin infinitely more scarce even than gold. Those are the fundamentals, plain and simple. Let's talk about technicals. The Bitcoin technicals have never been as bullish as they are now. This isn't a technical show, but we can't ignore the basics. The weekly and monthly charts for Bitcoin are all showing a likelihood of a massive run up in the price of Bitcoin over the next 5 years. Okay, so let me show you, bring up here a price chart, if I can get it on the screen here. Here we go. This is a chart that shows the price of Bitcoin on a log scale with bands provided by Real Vision. I'm a big fan of Real Vision and Raoul Pal and their work. We call these regression lines, and we use them to predict or try and predict future price movements. You can see on the right that these bands predict an upper price for Bitcoin of about $1 million within 3 years. That's about a 100x jump from today's price. it's just wow. Okay, I don't even know what else to say beyond obviously just wow. All right. Well, it gets better. 3 years, $1 million. Maybe that's a little bit of a stretch for some of you to kind of get your arms around. Let's make it a little bit more tangible. Let's look at the next few months. Right? Here's a price chart showing the 5-year 2012 to 2017 price of Bitcoin in blue. Right? So you see that blue line that goes up and to the right. That's 2012 to 2017 with the price on the right. And then on the left, we see the price in for the white, which is 2016 through today and then into the future. So if the blue is any indication for where the white is going, we're going to see Bitcoin in that 200 to 250,000 range next year. Again, this is not investment advice. It's not even really. I'm not a soothsayer. I'm not an oracle. I'm just telling you when I read the technicals overlaid on top of the fundamentals, this is what they tell us. The numbers are there staring us in the face. Okay. Okay. The last piece of my 3-part analysis on where Bitcoin is going has to do with what I call sentiment analysis. All right. Now, this is a little bit harder to put in very specific numeric terms. It's more of a qualitative perspective. One of my favorite all-time books is The Art of Contrary Thinking. I strongly recommend all of you go to Amazon and buy The Art of Contrary Thinking. Right? It's certainly my favorite book on investing and understanding how consumers think. The bottom line in contrarian thinking for investors is that when everyone is on the bus, it's probably time to get off the bus. When everyone is off the bus, it might be time to get on the bus if the investment has sound fundamentals and maybe interesting technicals. While everyone is waiting in line to get on the bus, that tells you you're in a new trend. It's very difficult to interpret Bitcoin sentiment. There are millions of Bitcoin wallets, potentially hundreds of millions, and with millions of wallet holders. We don't know how many of those wallets are individuals versus individuals having hundreds or thousands of wallets, for example. But there are billions of people on the planet. So millions divided by billions is still a very small number that is not even close to 100%. So it's like I said, it's very hard to capture this sentiment. But one of the things I've been looking at is consumer interest in Bitcoin by looking at the search history. So let me bring up this chart here if I can get it on the screen. There we go. All right. So this is a Google chart from Google Trends. You can just go to Google Trends and download it yourself. What it basically shows for the past 2.5 years, the search the quality or relative search interest in the phrase Bitcoin, the term Bitcoin. What this tells me is that the interest has completely flatlined since spiking a few years ago. Or in other words, from a contrarian perspective, everyone is off the bus. So if the fundamentals are great, if the technicals are great, and no one is on the bus, that's interesting. Okay. So what I want to see at the beginning of a sustained bull run is nobody on the bus. And on a relative basis right now on planet Earth, no one is on the bus. Okay. So when you start to see the line forming of people getting on the bus, watch out and get out of the way. So I may be slightly early in terms of sentiment analysis, but the other two, fundamentals and technicals, are so strong that it's worth the bet, in my opinion. So the bottom line is that combining the fundamentals, technical analysis, investor sentiment, for Bitcoin paints a picture that is more bullish than any analysis that I've ever seen. When I look at it this way, there is honestly no better place for me to store my wealth and savings than in Bitcoin. That's why I've chosen to put 50% of my investment portfolio into Bitcoin as of a couple of weeks ago. You may ask, well, hey, if you're this bullish, why didn't you choose 100%? Well, honestly, if I'm right about my analysis, whether I put 50% or 100% into Bitcoin, it won't really matter for me or my family's future. If you think about Apple stock or Netflix stock, there would be no way to have predicted their product execution in advance as a company, right? So people say, "Oh, well, I wish I'd gone back and bought Apple stock when it was, $2 post pre-stock splits." But you wouldn't have known pre-iPhone that Apple was going to make an iPhone or an iPod for that matter. With Bitcoin, we can actually predict its execution based on these factors. Again, I'm not telling you what to invest in. I'm giving you my personal investment thesis and explaining in very open terms, as open as I can, how I'm investing my own money. Okay. So I strongly encourage you, if you enjoyed that discussion, to share it with your friends, send them the link to this video. We'll parse this part out and create a separate version of the video for you to share on YouTube, Twitter, Facebook, et cetera, et cetera. Okay, so welcome everyone. I hope you enjoyed last week's discussion on the basics of Bitcoin and why it matters. That show is linked below for our viewers on YouTube, Facebook, Twitter. And by the way, if you're on YouTube, press the subscribe button on YouTube. That helps us promote what we're doing on YouTube and gets us to a better place with Google search results and things like that. And also sends us a strong indication that you like what we're doing. All right, so we've got lots of questions coming in already about stablecoins. This week, we're going to be talking about stablecoins, what they are, how they work, why they matter, et cetera, et cetera. I'll also answer any questions regarding my earlier comments on where Bitcoin is going, my personal investment thesis for Bitcoin. I've already seen, like I said, a whole bunch of questions coming in. We have a contest winner which we'll get to in a few moments. I'm excited about that. We're getting a great response on our contest. Okay. Oh, and by the way, welcome wherever you are. I see here my country tabulator. We've got people probably, it looks like it's about 25 countries last check. So keep them coming. Okay. So like I said, this week we're going to talk about stable coins, what they are, how they work, and why they matter. Stablecoin has become a catch-all phrase in the crypto world, referring to a token that basically maintains its value over time, hence the phrase or the word stablecoin. In other words, can we create a token equal to $1 today that is guaranteed to be equal to $1 in 3 months and 3 years? That's a stablecoin. In theory, we can have a stablecoin for gold or other commodities like oil or other metals, such that, for example, one gold token is equal to 1 ounce of gold at all times. Right, so that's another form of stablecoin. It seems like stablecoins are everywhere in the crypto conversation lately. Right, they have been front and center in the news, given the rumors that many governments are looking to create their own stablecoins, which they call CBDCs or Central Bank Digital Currencies. How that will actually happen is something we'll take a look at, and I've got a bunch of questions on this topic, which we'll get to. But just keep in mind that these central bank digital currencies are simply at their core more or less another form of stablecoin. Doesn't prevent government from printing money, right, at will. It just says that whatever coin you have, if it's $1 today, it's $1 tomorrow. That doesn't mean that the dollar is not worthless. It just means it's still $1. Okay? But it's worth noting that the other reason that people are talking about stablecoins is basically that they're controversial. It's not so much as and not as much based on the idea, but how they're implemented. Libra being a fantastic case in point, right? So many governments went nuts when they saw that some company with 1 billion customers, and that's, by the way, is the only reason why governments lost their shit when Facebook announced Libra, is because they have 1 billion users. If they had 0 users, nobody would care that they were trying to create a new currency. There's lots of companies that have already created stable coins. The reason governments didn't pay attention was because out of the gate they had no users, okay? And they could do things slowly and ramp up from a legal perspective and a technology perspective. Okay, so we'll come back to that. So what are stablecoins? From a tech perspective, stablecoins are cryptocurrencies that are pegged or backed by some other asset. Some forms of stablecoins are tied to analog assets such as the dollar or a commodity like a bar of gold or a barrel of oil. Other forms of stablecoins are backed by cryptocurrencies or even exist as self-correcting, algorithmically controlled systems, whatever the hell that means. In essence, stablecoins hold the promise of a step between traditional assets and crypto assets, which is actually how they've mostly been used in the early days of crypto trading. It's basically been a way to move dollars around quickly between exchanges without having to link your bank account to an exchange, and then move in and out of cryptocurrencies like Bitcoin or other altcoins, without having to provide bank details. So in essence, stablecoins hold the promise of a step between traditional assets and crypto assets, taking the best from both worlds while resulting in a more accessible and efficient form of finance. Lots of fancy words. Simple way of saying that it looks like stablecoins really hold the promise of being a key pillar to the next generation of banking. I would not be surprised if the traditional bank account was replaced with a stablecoin model, at least for the cash that we carry around with us, for the way we make payments, for the way credit cards settle or debit cards settle, the way business payments work. It just makes so much sense to eliminate a lot of these middlemen services in a lot of banking transactions. And if you've ever played with international bank wires, you know what a nightmare that is. Stablecoins hold great promise in solving that problem, but they're not without challenges. We'll get to the scalability issue um, in a few moments. Okay. All right. So before I get into the technology of stablecoins, how they work, and the key characteristics, let me answer some of the basic questions that I'm getting. All right. So let's see. We've got a question here. Um, I'm interested in learning about the effect of government regulation on stablecoins. Okay, so let me talk about that for a second. One of the most common types of stablecoins are basically fiat-backed stablecoins. And I'm planning to present that in a moment, but fiat-backed stablecoins basically means that the issuer of the stablecoin, you've heard of Tether, you've probably heard of USDC by Circle or TrueUSD or PAX. These are all fiat-backed stablecoins where the issuer of the stablecoin maintains the reserve of dollars, if that's the currency, in a bank account. Could be euros, could be RMB, could be Mexican pesos, doesn't matter. But the equivalent in dollars or pesos or whatever is in a bank account. And then you simply move the tokens around via the Ethereum blockchain or the Stellar blockchain or Omni or whatever blockchain is being used to represent the stablecoins. Now, usually, depending upon what jurisdiction the stablecoin is issued in, the party issuing that stablecoin, whether it's Tether or Circle or Trust Token, is a regulated entity. In the case of Paxos with Pax, they're, I believe, a trust bank in the United States, in the state of New York. And so, as a regulated entity, right, they're either a money transmitter or a bank or a trust company or some combination of all of those things. Okay. And so that gives them relative stability, at least from a oversight perspective, that some government isn't going to randomly come in and shut them down. Right. Tether is one of the unique ones where their regulatory status is a little bit unclear. And in certain markets outside the United States where I reside, people use Tether explicitly for that reason because they may not trust the United States government. At Abra, for example, we use, and this is another one of the questions that I see here, we use TrueUSD from Trust Token as our default stablecoin. When you wire money into Abra via ACH in the United States, via cash outside the United States, or via bank wire, it's automatically converted to TrueUSD because that's the default stablecoin that we use. And TrueUSD, again, is one of those fiat-backed stablecoins where they simply maintain on a one-to-one basis a reserve of stablecoins equivalent to the float of the stablecoin. So Ron, who asked the question why we chose TrueUSD, we chose TrueUSD for a couple of reasons. One, we knew that they were, you know, reasonably licensed and registered as a money service business, no concerns about government regulation. Their APIs for minting new tokens when customers deposited money were readily accessible to Abra. It was very easy to integrate, very easy to make them accessible to you. They're also available on all the major exchanges. So if you want to withdraw True USD to another exchange or another wallet, it's very easy to do. Almost all of them support, I think all of the major ones support True USD at this point. And also for deposits, if you want to move money from an external wallet that's already stored as True USD or even as Tether, you can move it in and exchange it to True USD if you like. So that's why we chose that one. But again, you can use all of them on Abra, to be clear. Abra supports Tether, USDC, True USD, DAI, PAX, and we'll get to DAI in a moment. The others all being, again, fiat-backed stablecoins, okay? Let's see, I think I have a couple of other questions. What's the difference in keeping my money in dollars or in stablecoins? Are stablecoins regulated somehow? What's the risk? This is from Oren. Oren, I just answered the question about regulation. Yes, they're regulated. If issuer of a stablecoin is holding your reserves as the party who initially wired the money, they are regulated. Okay, so that should give you comfort that Abra is working with parties that we deem are operating legally in whatever jurisdictions they're operating in. Okay, so the difference between keeping your money in dollars or a stable coin is that if you're holding the money in dollars, in a bank, the bank is actually maintaining a bank account on your behalf. All right. If you're holding stable coins, the bank is holding fiat reserves, not on your behalf, but on behalf of the party that issued the stablecoin, such as Trust Token or Tether or Circle. Okay, so that's a pretty big difference. The other big difference, of course, is that you can move those stable coins person to person simply via your Abra wallet or whatever other cryptocurrency wallet or exchange you're using without actually touching your bank account. But legally, the value is supposed to be pegged one to the dollar, whether you're in a bank or in a stable coin. In that regard, should make no difference. Okay, so let me get back to my little soliloquy on what stablecoins are and how they work. All right, so from my perspective, a stablecoin as a form of optimal cryptocurrency should have four characteristics. It should be based upon a platform that's decentralized. And what I mean by that is, in today's parlance, you would think about a blockchain like Ethereum. Tether launched on Omni. Circle uses Ethereum, but also just announced support for the Stellar blockchain, Stellar being an investor in Abra. So this idea of a decentralized blockchain is a central tenet shared by all cryptocurrency proponents. A lot of people disagree on which one is the best or which one is more decentralized. We'll leave that aside for a second. But decentralization exists on a spectrum amongst various cryptocurrency projects, partially based upon how early they are, partially based upon the type of system that they've decided to create. Ethereum being relatively more decentralized than, let's say, an early project or something like XRP, which tends to have a lot of centralization in its ownership. But the fundamental idea is that crypto systems should not rely on or be controlled by a central point of failure or any powerful agent capable of censorship, such as a government, corporation, or even a bank, right? So the goal of decentralization is to create more robust security and a means of community control. So again, it's not a technology show, but you should understand the basics that if you're using a stable coin, you're basically using a blockchain. Today, probably Ethereum. In the future, you may also be using other blockchains like Stellar or Cardano, and your coins are basically represented on chain via those blockchains. The next tenet you need to understand is privacy, right? This is another of the fundamentals of cryptocurrency systems, that privacy should be baked into the underlying protocols that make up crypto's infrastructure. So even Bitcoin has been having, or the Bitcoin community has been having a lot of privacy debates lately about how to improve the privacy of Bitcoin transactions. And we've seen some legal actions in this regard as well, which are making this conversation more acute. But like decentralization, privacy within crypto exists on a spectrum. The idea that new forms of digital value should be censorship resistant and insulated from surveillance are viewed as core pieces of cryptocurrency architecture. Okay. All right. So the next concept here is scalability. In order for cryptocurrencies to compete with traditional fiat currencies, they need to be able to scale. This is a big problem, right? So right now, the ability to grow beyond niche projects is one of the biggest issues facing cryptocurrencies. Scaling bottlenecks increase transaction times and increase the cost per transaction. We know even Abra users have been frustrated. If you try to do very small dollar stablecoin transactions, the transaction fees can often be more than the amount you're sending. This is going to be resolved over time with Ethereum 2.0, competing technologies. Again, I think we're going to see lots of competition in this space, especially from Stellar and the projects like Cardano. But until that happens, Ethereum remains without a doubt the biggest bottleneck for stable coins to scale today. DeFi and the DeFi world has made this problem very acute and put it front and center. We've seen spikes in gas fees, for example, on Ethereum, largely due to uptake of DeFi projects where every transaction is happening on chain. If you use Abra or other exchanges like a Coinbase or Binance, a lot of your transactions are happening off chain until you move your funds. And so it doesn't really impact the scalability of the blockchain itself. Okay, so that's a problem that needs to be addressed. The last piece here is this idea of, now we're talking about stablecoins, price stability. Um, in order for a stablecoin to be used as a digital version of cash, the price needs to be stable. So Bitcoin was first conceived as a peer-to-peer payment system, but now Bitcoin is, at least for the time being, acting as a better store of value than as a cash-like peer-to-peer payment system. A lot of people believe that other systems like a Litecoin or like a Bitcoin Cash may play that role over time. We'll see. But independent of those new cryptocurrencies, part of the reason that a currency needs to hold its value steady is so that it can be exchanged. If the price of a currency fluctuates in value by several $100s in a single day, like Bitcoin has done this week, it makes it very hard for people to confidently use the system like traditional cash. Again, great as a store of value or as an investment, but maybe not perfect for short-term payments, especially ephemeral payments like you might use Venmo in the US or an M-Pesa in Kenya and things like that, or WeChat Pay in China. So this works both ways because if the value of Bitcoin is falling, people might feel like they're losing money, which they won't want to do if they're receiving the payment. And if the value, of course, increases rapidly, again, you have that incentive to hoard the Bitcoin or other cryptocurrencies and not use it for purchases per se. So working from that kind of generic concept, stablecoins directly address this price stability, which is great for these kind of ephemeral, quick fleeting payments that I think are essential to this next generation of digital banking, digital payments, and crypto trading, for example. So that's the kind of basics of what I would look for in the design of a stablecoin, right? So the idea of a stablecoin or of pegging one asset to another to keep values consistent is not a new concept, right? This is something that governments have been doing with their own currencies for decades, right? So it's not a new idea. Some countries have developed currency pegs to avoid cycles of high and low currency valuations over time, and some have actually given up and said, "Hey, we're just going to make our currency equal 1-to-1 to dollars and maintain reserves." This has given the U.S. in particular significant power on the global stage, given the dollar's status as a reserve currency. By the way, this was the topic of my original TED Talk on Bitcoin almost, I think it was 9 years ago. I think Bitcoin was trading at about $4. And I gave a TED Talk saying, hey, is it possible that we end up with a new type of reserve currency in the future once we do away with the dollar? Anyway, so back to our story at stablecoins. So there's been a few different ways of implementing currency pegs at the national scale. Some countries just start using another country's currency, like I said. Other governments have decided to set a fixed peg. China was doing this for a very long time, and they were viewed as a currency manipulator. Anyway, or if you're already watching this video, you're probably familiar with the basics of all this. So as I said earlier, when we were answering some of the user questions, there are a few different types of stablecoins, but there primarily are three. There are variations on the three as well. The most common type today, and the type you're probably using if you use Abra, for example, is a fiat collateralized stablecoin. This is the crypto version that most closely resembles the traditional currency peg that I talked about a couple of minutes ago. But because of its familiarity, it's also the style of stablecoin that's been the longest in development and usage, and also because it's relatively easy to implement. You simply have, for all of the value of stablecoins in circulation, you have that much money in a bank account. Okay. So the most recent, of course, the most recent project over the last few years that's got a lot of attention is Tether. Tether is backed by US dollars. I think there may be non-dollar tethers as well, but Abra supports the dollar tether. And the advantage of these fiat-backed crypto stablecoins is that moving traditional assets into cryptocurrencies becomes very, very easy. You don't have to link your bank account if you already have the stablecoin. You can move between wallets and exchanges. You can send money to other traders or other friends. You can even buy items online, all without using your bank account or even a third-party wallet app. All right. So even things like paychecks or taking out a loan in crypto might be more straightforward with a fiat peg. The disadvantage is that fiat-backed stablecoins are generally susceptible to centralization because, of course, who's ever issuing the stablecoin has to maintain that huge bank account of reserves. So companies like Tether, Trust Token, Paxos, they maintain bank accounts of billions of dollars, which manages the reserves of the tokens that you are holding. So in that regard, you are trusting the issuer of the token, even though the blockchain itself might be decentralized. I hope that makes sense. Okay. So before I get back to questions, let me just briefly mention the other two types of stablecoins. The other type of stablecoin that's getting meaningful usage today is what we call crypto collateralized stablecoins. And if you've ever used DAI, DAI, and Abra supports DAI, you're using a crypto collateralized stablecoin. So these crypto-backed stablecoins, they use a pool or pools of cryptocurrency to help provide the backing required to maintain price stability. So the advantage of using other cryptocurrencies as collateral as opposed to dollars is that the system is programmable because it's based on computer code, and you don't have to rely on a central bank account to maintain the float. But the disadvantage is that these crypto-backed systems are not as insulated from market fluctuations as fiat-backed systems. In other words, if you back a DAI using Ethereum or ETH wrapped Bitcoin, you need to basically change the amount of Ethereum that's wrapped up in a contract if the price goes down. There won't be enough Ethereum. And if the price goes up, you need to add more Ethereum so that the value of your DAI stays the same. And the smart contract has all kinds of magic in its computer code that makes that happen. Okay, super interesting. And I think that is a big part of the future of money, in my opinion. The last part I'm not going to spend much time on. It's very complex. It's what we call algorithmically controlled stablecoins. It's more of the latest innovation. There's really no algorithmically controlled stablecoin that's getting any kind of meaningful traction today. Companies have tried. They've had some legal issues with it. A lot of confusion over what the legal status of these things are. So rather than backing crypto with fiat or other crypto, you basically use algorithms, kind of like in a central bank style system, but instead of a monetary policy via a government or a nation state, the monetary policy is controlled via some type of program. So you could actually take money or stable coins out of circulation, for example, based upon some arbitrary policy that the system creates. Okay. All right. So those are kind of the tenets of stablecoins, the different types of stablecoins. As I said, today you're probably using a fiat-backed stablecoin like TrueUSD and Abra or Tether, USDC, Pax or Paxos, and you may be using, especially if you're using DeFi. We have a lot of people who use Abra to create DAI from other stablecoins and then move the DAI out of the system. So lots of different things you can do with that. Let me talk for a moment about central bank digital currencies. Okay, we've got a lot of questions on what are called CBDCs, central bank digital currencies. Let me get to those now. I'll just start off by the first question, of course, was I see here from a couple of people, what are central bank digital currencies? Are they going to replace stablecoins? Well, first of all, a central bank digital currency is basically a form of stablecoin, right? Instead of a private company taking cash reserves, putting them in a bank account, and then issuing tokens, the central bank is simply issuing the stablecoin directly instead of printing a piece of paper. Or they can print the piece of paper and hold it in reserve themselves. They can do either, and they can intermingle either. Now, this has, in theory, several advantages. First of all, let's get the basics out of the way. Central bank digital currencies does not mean that because there's crypto stablecoins that central banks are going to stop printing money at will. It's the opposite. This actually makes it easier for them to continue their irresponsible behavior of simply printing money at will. It has to stop. It's not going to stop because of technology. It's only going to stop because they change their perspective and the public demands that we start basically having a stable store of value at the nation state level. And we have no visibility into that happening. Okay, so a central bank digital currency has nothing to do with monetary policy. It's simply another technology for managing the money supply as opposed to using paper and bank systems. So if you're in the United States, you may remember that back earlier in the spring and summer, people got money from the government to deal with the very high unemployment as a result of the COVID-19 crisis. With a central bank digital currency, in theory, the central bank and the Treasury could bypass the traditional banking system and literally put these stablecoins or CBDCs directly into a consumer's wallet, right? And that's an interesting idea. And I would not be surprised if we start to see that in developing markets. By the way, I saw an announcement that I think it was Barbados or Bermuda. I apologize to my friends in the Caribbean. I know there's a bunch of you on here. I'm sure one of you correct me that the government of one of those countries announced a stablecoin or CBDC called Sand, which I think is a great name for a Caribbean-based stablecoin. Um, so another question, and I just saw this come in via Andy, and Andy, you weren't the first today to ask the question. I think it was asked 3 or 4 times earlier, but I just saw your question come in. Are there any prospects for privacy with these central bank digital currencies? That's a good question. Now, obviously, from a technology perspective, if they want to make these transactions private, it is very easy to do so, right? However, banking systems and regulation seems to be moving in the other direction. So my big concern with these CBDC projects is we're going to lose the privacy of paper money in favor of the convenience of digital currency. And that's not a good thing. It doesn't have to be that way, right? So I don't know the answer. I don't know what China and the United States and Western European governments, who are, the most important countries in terms of creating CBDCs, are going to do in terms of privacy, but I hope they do the right thing and allow for small dollar transactions to be completely private. I can understand if they come in, I don't like it, but if they come in and say, hey, if you're going to move $1 million around, here's the process and it's not going to be private. I don't like it, but I get it. All right. Ideally, if you're using cash, it's cash. Now you have your own reporting requirements. If you have to pay taxes on something, if you're moving money cross border, there's requirements today, and I can see those requirements remaining the same, whether I agree with them or not. No problem. Okay. But it's up to the governments to decide how they're going to use this new technology. And it's up to us as the citizens they represent to make damn sure they understand that we demand privacy in our financial system, right? And this is not a new just a new anti-money laundering scheme. I am not in favor of money laundering, but I am very much against us giving up our financial privacy because of a few bad apples. Okay, so sorry for my rant on that topic, but I feel very strongly that you should all go to your governments or participate in any forums that they give you and make your feelings on this known. Okay, I'm going to have a slightly shorter show today, so I'm going to take a couple more questions. Before we do that, I want to announce our winner. Our winner is Richard Ladiana from our online Twitter contest. And congratulations to Richard. Richard's question, of course, was what is the real use case of stablecoins? Is it all just for traders in general, or are there other viable use cases? That is the key question. So congratulations, and I'm happy that therefore that you won. And so we'll follow up with you on Twitter to get you your winnings. But to answer your question, stablecoins were initially created and adopted out of necessity because people couldn't access certain exchanges because their country's bank accounts weren't supported, for example, or doing bank wires was too hard, or other exchanges actually had no KYC, and so they couldn't access the banking system. Most exchanges have KYC now, but in the early days it was kind of a free for all, and others didn't. And they used stable coins like Tether in order to facilitate trading in dollars, because you could basically get the Tether somewhere else, even for cash, and then move it onto the exchange. That's mostly not possible today because pretty much every exchange will ask you for, even if they're just taking Tether and not your bank account, they'll ask you for your ID information. However, I think stablecoins, whether it's the stablecoins issued by private companies, which I'm more bullish on, or the government issued ones, which I have my concerns about, which we just talked about, have a huge future to play in the future of banking, and the migration of banking from its current model to one that's 100% based upon internet and internet-centric technologies, which hasn't happened yet, right? Mark Andreessen, the famous venture capitalist, has this infamous saying that software is eating the world. It hasn't really happened in banking, except in this area of cryptocurrency. Everything, even when you use your phone to access your bank account, you're basically using the same old 1970s, core banking systems, mainframes, blah, 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 right? We're going to change it from the inside out. Companies like Abra are on a 10-year, decades-long mission to change banking from the inside out, and stablecoins have a key role to play in that transition. It's awesome. That means that money transfer, payments, you know, purchases, right? When you buy something with a credit card today, it is unbelievable how many participants are involved in that transaction in the background that you don't see, right? Stable coins are one way of eliminating a lot of those participants in the transaction, okay? And you could literally settle between a merchant and the issuer of the card, or in the case of a purchase, between the issuer of the card and the merchant via, let's say, Visa or MasterCard, bypassing all of those middlemen. Now, those middlemen are not going to be too happy about what I'm saying, but that's been the nature of the internet since my Netscape days 30 years ago, right? The internet has always eliminated middlemen in favor of the consumer or the businessman. And that hasn't happened in banking yet, but it's about to happen. And stable coins have a big role to play in that by facilitating different forms of payment, purchases, money transfer. Back to Libra, Libra was created on this idea that by eliminating the banks from the equation, they could make person-to-person money transfers via WhatsApp or Instagram or Facebook Messenger infinitely more reliable, faster, cheaper, et cetera, et cetera. Now, governments don't like that. They're not incentivized to like that because they lose a lot of control. So they're trying to make damn sure that Facebook does this in a way, or the Libra Association does this in a way that's totally above board and regulated. I don't have a problem with that as long as they let them do what they want to do if they're operating within the confines and the laws that we all agreed to create. Right? Don't make different laws for somebody if you don't like what they're doing. We should all operate on a level playing field. Okay, so a couple of things, since we're not going to get to all the Abra specific questions today, support at abra.com is your best bet for all support questions. My team, I see, has been online answering questions in the Facebook and other channels as we go. Thank you so much for that. I know all of you really appreciate that. If you don't get your question answered directly, you can always send an email to support at abra.com. They'll answer your question there. And if we get a lot of those questions, they do impact what we talk about in subsequent shows, by the way. So even if you're not sure if it's a good question, ask the question, right? It also helps us to think about what you're thinking about, which is important to us to know. All right. A couple more. I'll take a couple more questions on stablecoins, and then we'll call it a day. Can you use cryptos as a preservation value and initiate a barter economy so we don't have to worry about volatility? This is a question from Carl. Carl, yes, that's exactly what we've been talking about. So stablecoins basically are a better way to barter as opposed to crypto in the short term, right? Now, there's a whole bunch of schools of thought around when that's going to change. I actually think that Bitcoin will become better than cash, even for barter in some or at some point in the future. I don't know when that will be. But if you follow, for example, the Austrian School of Economics, they actually predict exactly what's happening with Bitcoin. If you have a deflationary asset, which is what Bitcoin is, meaning it's not inflated infinitely like cash is, Bitcoin therefore is deflationary, which is the opposite. They predict that when a new deflationary asset like Bitcoin is created, it will be hoarded, which is exactly what's happening with Bitcoin. Once its value reaches a certain point, it will make sense to start to spend it, right? For a couple of reasons. One, if I had no Bitcoin and I bought some and it's now worth $100 million, it makes sense that I'm probably going to buy something with it, right? So over time, people will loosen up those purse strings and start to use Bitcoin for barter, but you'll also see its value stabilize. It may take, I don't know, a decade or even 50 years. I don't know. It's not really our concern right now, but it eventually will happen. So in the meantime, we have these stable coins and we'll eventually migrate to new forms of crypto like Bitcoin for payments as well as store of value. Okay, let's see. There has to be a way to block government oversight altogether, being headquartered in Switzerland, maybe, Charles. So, Charles, fair question, fair comment. I have to say, I think the answer to that is I don't think so. If you think about US regulation, for example, US banking regulation and US securities and commodities regulation has moved in the direction of we don't care where you're domiciled, we don't care which customers you claim you're serving. Our law knows no extraterritorial limitations, and we will find you. That is a problem because it's like Metcalfe's diagram. If you know anything about networking, the more countries you have, the more of a crazy mess this becomes because you have to deal with the regulatory requirements for every country, even if you're not operating in that country, which is just unscalable. The US has no right, in my opinion, to police the world. But that's the role that they're taking. So Switzerland, for your question, does not matter. There's been rumblings this week that Ripple may move to London because of U.S. regulatory concerns, and that is the wrong reason to move to London because ultimately it will not matter, right? And so we saw this with BitMEX. Now I'm not opining on whether the BitMEX guys are guilty, but it really makes no difference to U.S. regulators at this point. They will come after you if they have concerns about what you're doing, regardless of where you're located. And look, if people break the law, I guess my comment is don't break the law. But if we don't like the laws, or if we don't like how jurisdiction within laws is defined, then it's incumbent upon us to make that known to the people that we elected to represent to make those ridiculous laws in the first place. And I invite all of you to do that. Now, in the meantime, we have every intent of following every law that's out there to the letter or beyond. But we will also do whatever we can to make our opinions known that we want certain laws changed over time, as all of you should as well. Okay, so too many rants today. All right, so let's see. I'm going to take one more question. We actually ended up 50 minutes after all. So you all managed to get me talk longer than I had expected, which is great. Keep the questions coming. We'll get to them online, get to them next week. Does the price on the charts that you are showing take into account the scalability of the blockchain, or are those pure price speculation? So most models out there for things like stock to flow or the charts that I showed you with the regression analysis on Bitcoin have no understanding of the scalability of Bitcoin, the scalability of Ethereum. It's all based upon price and other technical analysis. So to answer your question, it is pure speculation about the future. And I do worry about Ethereum's price vis-a-vis this scalability issue. And if 2.0 doesn't come fast enough, it could really hurt Ethereum versus other projects. And that's the opening. That's why I've said this for 2.5 years. We need competition in cryptocurrencies to address the shortcomings in cryptocurrencies, including Bitcoin. Bitcoin is not perfect. It is the best money I've ever seen, but it is not perfect. The more competition it gets, the more competition we have in crypto, the faster these things will get better, the faster they'll improve, and the faster we'll all be happier and better off for it. So yes, the charts I showed you were purely about price speculation, but we need these competing technologies to help address these scalability issues that you were alluding to in your question, okay? There was a question about interest rates and Abra interest accounts. Let me just answer that as the last question. For those of you not familiar, The Abra interest account allows you to earn interest on your stablecoin deposits. We've talked about stablecoins. We support TrueUSD, Tether, USDC, and Paxos stablecoins, and you can earn, as of today, the rate is 10%. It's unbelievable. In my opinion, it's the best deal. I can't say in banking, it's not a traditional bank account, but as close as you can get without being a bank, in my opinion. We work with Prime Trust, a trust company based here in the US that maintains these balances for us. And we work with our awesome investment committee and lending desk to generate this yield for you. So that's how we're able to generate yield on stablecoins. Other DeFi projects, I see Victor here, I'll take your question last, have the ability to pay interest based upon different algorithms when you're actually lending money to the system and staking money in the system. That's a whole other conversation. You can actually go and look at the code and see how the rates are set, but I'll take that at another time. We'll set up another back to basics on DeFi, and we'll talk about how DeFi systems pay interest rates. But right now, you're going to get a more stable yield at Abra than you are on one of these DeFi systems. Now, their rates may spike, where a few days you may get a higher rate, but their rates may plummet, where for a bunch of days you're going to get a lower rate. But you're also, again, DeFi is a beta concept. Be very careful. We have people putting a lot of money into Abra. It's a system that I trust. It's a system that's highly regulated. And it uses crypto the way crypto, in this case, stable coins were meant to be used. I think the promise of DeFi is awesome, but it's not ready for $100 billion. It may get there, but buyer beware. Okay, so if you have any other questions on the Abra interest account, you can send an email to support@abra.com. Try it out via the Abra app. It's awesome. You can, I'll show you here. If you go into the Abra app, here's our demo wallets with our demo balance. You can see a whole bunch of money earning interest. You can see the rates on the right-hand side of the screen, and people just love it. So you click on that interest account, you get set up in a couple of minutes, and you're good to go. All right, I'm going to stop there. So, yeah, 50%, I'm all in. I'm all in on Bitcoin. I've got no plan B, as they say, pardon the pun, in crypto and or in Bitcoin. And we'll see how this goes. But right now, let's see where we're at. Bitcoin is, it's on the move. So I think it's going to be an interesting few days. Again, I'm in this for the long term. I'm not a short term trader. We've had a bit of a price pullback the last couple of days. I think we're down to 12,800. That's probably healthy. But again, I'm not in this for short term trading. I'm in this for for the long term. And right now, like I said, the long term is looking extremely bullish. All right. Have a fantastic weekend, everybody. We'll see you next week on Money Talks. Take care, everyone.